So before we get started, if you have any questions during the presentation, please feel free to type them into the question box. We will have time for a question and answer session at the end. Without further ado, let us welcome Mr. Tan. Mr. Tan, over to you.
Thank you very much. Thank you, Yvonne, for that kind introduction. Good afternoon, everyone. Thank you very much for attending this session during the lunch hour. Do allow me to share my screen. Okay, like what Yvonne has mentioned earlier, I think 16th of March, I think marked a very, very important day and an inflection point in the Chinese equity stock market. And in today's presentation, we will talk a bit about what has happened over the course of the last few weeks that has caused the market to think very differently in terms of the prospect of the Chinese equity stock market. So I think the case in point is that on 16th of March, I think Vice Premier Liu He made some major policy announcements over the course of the day that caused the market to reverse its direction, like what Yvonne has mentioned earlier. So in today's presentation, we will talk a bit about some of the statements that he has made, and also more importantly, the implications that all these statements have on the equity markets in China. Last but not least, we'll leave some time for Q&A for this afternoon session. Do write up your Q&A in the section below. Okay, and let's jump right into the presentation. Okay, so I think key policies were announced on 16th March, what Yvonne has mentioned earlier. I think this is a very rare and highly significant event, right? Especially coming from the mouths of such a very important person like Vice Premier Liu He, right? So his support of the economy, as well as his clarification on quite a few of the concerns that the market had, also boosted the optimism in the Chinese equity stock market. As you can imagine, right, prior to that, I think the market was worried about quite a few things, right? So let's talk specifically about what he did and what he said over the course of that particular day, right? So on 16th of March, the Financial Stability and Development Committee, that's led by Vice Premier Liu He, held a very rare meeting, and most importantly, they chose to send some key signals directly to the market. And these are some of the key things that he mentioned. So all in all, it was a 5,000-word document that was circulated to the public. And I've summarized the 5,000-word document into four key directions and four key changes that we think would have a significant impact on the equity stock market. First and foremost was that Liu He mentioned that China and US regulators have made positive progress and trying to work on a concrete cooperation plan on the regulation of US listed Chinese listed firms that are listed on the US stock exchange or the ADRs, right? So we can talk a bit more about that. And also more importantly, he did voice support that the Chinese government will continue to support listing in overseas stock market. So this is the first time that we hear someone from a senior member of the China leadership voicing support of listing in the overseas stock market. And also, the government also mentioned that they will launch effective risk prevention and mitigation solution for the real estate company. I'm sure all of you keen Chinese watchers out there are well aware of the situation of the Chinese property market at this juncture, right? So the government on that particular day, 16th of March, came out and said that they will implement solutions for the real estate sector. So that definitely caused the investors in the equity stock markets to actually take up and to sit up and take notice of what has happened. And last but not least, one of the most important things that he said was that relevant government departments should complete the rectification work on large internet platform companies as soon as possible. So I'm sure all of you are aware that over the course of the last few quarters or so, since the Ant IPO was suddenly pulled, right, I think there was quite a fair bit of regulatory scrutiny on the Chinese internet companies. So that essentially put a flaw in terms of the rectification work that needed to be done, right? So last but not least, right, I think it's important for investors like ourselves, right, to see whether is it all talk or do they actually walk the talk. So following the meetings, right, so various regulatory bodies like PBOC, SAFE, CSRC, and CBIRC all came out and say that they have pledged to carry out the Financial Stability and Development Committee's instructions as soon as possible, right? So that was the key thing that happened on the afternoon of 16th of March this year, okay? So we will now talk a bit about specific comments that he made, which we think would have a very, very significant impact on the Chinese equity market. So, and this is what he said on 16th of March. And he said that the efforts to rectify internet platform companies should be completed as soon as possible. And in our view, I think that's very significant. Reason is because this is the first time we are hearing such statement. And that's very important coming from such a senior person like the Vice Premier, Liu He himself, right? So, and in fact, it's our view since December of last year that we have probably come to the tail end of the regulatory crackdown on the Chinese internet sector, right? So our view was that we are probably past the worst of all this regulatory tightening. So I'm sure all of you are quite well aware, like what I mentioned earlier, right? Since the Ant IPO was suddenly put in about 18 months ago, I think there was quite a fair bit of fear and concern in terms of what the Chinese regulators might do to the Chinese internet sector, right? I think our base case view was that I think 2021 was the announcements of all the fines and the announcements of new regulatory framework. But 2022 will be more of implementation of this new regulatory framework. And the fact that Liu He himself came out and said that this rectification efforts, right, should be completed as soon as possible, certainly gave us added confidence that we are really past the worst of the regulatory tightening, right? Because at the end of the day, the regulatory tightening is all led by the Chinese government. So for Liu He to come and say that they should complete it as soon as possible, right? Our view is, I think that probably marks, I think for us, right, it officially marks the worst of this regulatory tightening. I guess what I'm trying to say that we are not saying that there won't be any regulatory tightening from this point onwards. I think this is China after all, right? The government will intervene into different sectors as and when they see fit, right? But this is part and parcel of investing in China. But what I'm trying to say is that we have probably seen the worst of it, right? So last year we see a whole host of different regulations. So I think that the bulk of this regulation is really behind us, right? So I think that is definitely will give the stock market a much needed relief, okay? And also more importantly, right, from a fundamental perspective, our view is that the Chinese internet sector is exhibiting deeply distressed valuations, right? I think it has more than pricing the worst case scenarios. The Chinese internet sector at that point in time was trading about 13, 14 times PE with a 20% EPS growth rate, right? And for a lot of these firms, I think the net cash is roughly about 30% of market cap. So X cash, right, it's trading at 10 times, which is very, very cheap, right? So some people, may push back and say that, this is like catching a falling knife, right? We also understand that, right? But our view is that sometimes catching a falling knife can be extremely rewarding as well, right? But we have to be careful, right? That, we do not cut ourselves, right? But once again, I do think that, in short, I think the fact that Liu He came out and essentially said those words, right, means that we are probably at the end of this regulatory tightening. Okay, next we move on, right? Like what Yvonne has also mentioned earlier, I think there's quite a fair bit of market concerns on the possible delisting of the US listed Chinese companies, or what we call the China ADRs, right? So maybe just a bit of background on why the market is worried about this. So in 2020, right, the US government passed what we call the Holding Foreign Companies Accountable Act, or the HFCAA. Under this act, it actually allows the SEC to delist companies if American regulators are not able to review company audits for 3 consecutive years. Okay. However, for these Chinese companies that are listed on the US stock exchange, they are caught between a rock and a hard place. The reason is because for a lot of these Chinese companies, right, they are also governed under Chinese laws, right, because these are Chinese domicile companies. So under the China security law, it actually contradicts the HFCAA because the audit papers of Chinese companies are considered state property and therefore are not accessible by foreign regulators. Bearing in mind that I think all this law was set up decades ago, right? So, you can argue that some of these regulations could be a bit outdated because at that point in time when these laws were set up, there were no such things as ADRs, or ADR was not such an important feature of the Chinese stock market. But currently, right, so what is happening is that, like what I mentioned earlier, a lot of these US listed Chinese companies are caught between a rock and a hard place. So if they were to appease the American regulators, then they would run afoul of the Chinese regulators. So that's why, it's actually not something that the individual companies can solve themselves, right? So it has to be a G to G kind of conversation. So it's only at a government level can they solve these issues that that I've highlighted here earlier, right? So and I think what is more important is that on 16th of March, Chinese government actually said that they will support overseas listing, and they're working with the US government to formulate a detailed cooperation plans. So in fact, there has been a bit of an update since 16th of March. We have also heard that over the course of the last few days, in fact, this is very, very new news. Over the course of the last few days, the Chinese regulators are thinking of modifying the regulations to allow foreign regulators to get access to these audit plans, right? So they are making headways as we speak. Okay, so a point I want to highlight to everybody is the Chinese government is indeed working very hard in order to accommodate the request of the US SEC. Okay, so that's one. And the other thing I also want to highlight to everybody is that I think there is quite a fair bit of irrational panic to this potential US ADR delisting, because under the HFCAA, right, if these regulations were not being met by these Chinese companies, then they are liable to be delisted. But the point I want to highlight to everybody is that I think this is already made known to all these Chinese companies already. So they've already made plans to have their secondary listing or their dual primary listing in Hong Kong, right? So for us as investors, like for myself, right, the funds that I'm managing, it's, I am able to switch from the US listing to the Hong Kong listing with minimum funds and nominal fee, right? So there's no real impact to most of the investable, to the investor base anyway, especially those who are institutional investors, right? So we don't think that is in essence, right, in the real world, right, it will be much of an impact, right? In any case, right, the actual delisting timeframe is actually 2 to 3 years away from now, right? So which is a lifetime if you think about it in the investment time frame, right? So our view is that the companies themselves are well aware of the situation, so they are making plans already, right? And so I want to highlight is, it's not as though that when they get delisted, the company shares will be worthless, because end of the day, right, if these companies have secondary listing or dual primary listing in Hong Kong, then essentially on the very next day, you just do it with, you just have to switch it over. You can do it with minimum funds and nominal fee, right? More nominal fee, meaning it just costs you tens of US dollars, right, to do that conversion, right? We have done it and we have seen how fast free and how cheap it can be, right? So I don't think it's going to be a real issue. But having said that, I do think that a lot of investors out there are worried, right? So I do think that some of these worries are misplaced, right? So, and the other thing I also want to highlight to everybody is that the Hong Kong Exchange have also made it easier for a lot of these Chinese ADR to move to Hong Kong, right? So I'm sure the Hong Kong Exchange is more than happy to welcome this Chinese ADR with open arms, right? So I do think that if we were to fast forward all of this, I think history will show that in fact it is the Hong Kong Stock Exchange that will benefit massively, and in fact it is the US Stock Exchange who will suffer, right, because of these delisting efforts. Okay, this is something I just want to point out to everybody. Okay, and on this chart here, I just want to point out to everybody. I want to point out to everybody that this is some of the key Chinese ADRs with secondary listing in Hong Kong already. Right, so this is some of our key stocks that is under our coverage, and on this chart here you can see all the major names already have secondary listing in Hong Kong, and Bilibili in fact is going to be the first to have a dual primary listing in Hong Kong. So I think our view is that a lot more of these companies will make their way back to Hong Kong, right? So once again I just want to highlight to everybody, we don't really think that there is a cause for panic, right? And in any case, like what I mentioned earlier, both governments are trying their best to accommodate the wishes of the US SEC, right? So and like what Liu He has mentioned, the Chinese government is supportive, right, of Chinese companies being listed in Hong Kong, right? So they will try their best to be supportive and try to accommodate the wishes of the SEC. Okay, so with that, actually, with that kind of clarification, I think that is one of the main reasons that on the 16th of March, a lot of these Chinese ADRs rallied massively. I think people were a lot more comfortable with the fact that there are real progress that is being made. So we do think that it actually gives opportunity for patient investors like ourselves, right? Who think that in actual fact, I think this thing will be resolved one way or another, right? So this is a great time for us to get our positions into all these quality listings, which we think have been derated for no good reasons. Okay, and moving on, and on 16th of March, I also want to highlight to everybody that there was an article that was published on that day that essentially clarified the position of China in this Russia-Ukraine war, right? So in the case of China, right, I think once again, I think China is caught between a rock and a hard place, right? So on 5th of February, Russia and China proclaimed that there is no limits to their friendship. In Chinese, they say that there's no 没有上限, so there's no limits to the relationship between these two countries. And also, China has abstained on 2 UN votes to condemn Russia's invasion of Ukraine on which actually happened on February of 24th, right? And actually on 14th of March, right, US official, okay, unnamed US official came out and said that Russia has been asking China for military and economic assistance. So that happened actually over the weekend on the 14th of March, and that caused the market to derate quite hard for 2 straight days, right? However, these US claims were both denied by Russia and China, right? And I think a lot of people were quite worried when that news article came out on citing US official that Russia has been asking China for help, right? So, and they were worried that if, let's say, Russia asked China for help and China actually got involved into that conflict, then China might be implicated and therefore might be subjected to all the sanctions that we have seen Russia have been subjected to. So that was something that the market was worried about. And the other thing I also want to highlight to everybody is that in certain quarters, right, I think there was some narrative being pushed around that because of the whole Russia-Ukraine war, right, then China might do the same thing to Taiwan, right? So I think, however, once again, right, we don't think that that's going to be a base case. We don't think that China would invade Taiwan. That's definitely not our a base case. However, I also want to highlight to everybody that you will notice that China did not come out and actually point fingers or try to cite one side or the other, right? Because end of the day, right, if they were to side with Ukraine, that means that they will be on the same side as US, and that might complicate matter, right? So, because end of the day, if you think about it, right, the common saying, the enemy of my enemy is my friend, right? So once again, that's why I thought that China is caught between a rock and a hard place. So this is one of the main reasons why prior to 16th of March, I think the market will worry about quite a few issues. In particular, China's position on the Russia-Ukraine issue, and whether what is China's position on the China-Taiwan issue as well, because people were extrapolating what has happened to Russia-Ukraine to what could potentially happen between China and Taiwan. Okay, and however, on the 16th of March, right? So in fact, the Chinese ambassador to the US actually published an opinion piece on the Washington Post, right? So the key highlights of that particular piece was that he made it very clear what was China's position, right? Which included these following statements: that the sovereignty and the territorial integrity of all countries, including Ukraine, must be respected, right? And he made it very clear that China recognizes Ukraine as a sovereign state, right? However, in this particular opinion piece, he also made it very, very clear that Taiwan is an inseparable part of China. However, the future of Taiwan lies in the peaceful development of cross-strait relations, and more importantly, that China is committed to peaceful reunification. So in my opinion, I think that particular opinion piece was a very, very important and significant statement made by China to the world, right? So I think in no uncertain terms, it made it very clear where China stands on Ukraine, and also where China stands on the cross-strait relations, right? So this is something important that I just want to highlight. And once again, I think this also made it very clear to a lot of investors that, I don't think that the Russia-Ukraine situation can be extrapolated to Taiwan, right? Because this is not what China wants, and this is ultimately, if you think about it, this is not what China has been aiming for, right? So I don't think they're going to invade Taiwan. So once again, this is our view at this point in time, and also more importantly, right? You will notice that they also made it very clear that Ukraine's sovereignty must be respected. So I do think that that made it also very clear that China will not get involved in the war, and therefore will not be subject to all the sanctions that we have seen, like for example, getting kicked out of SWIFT and all the sanctions that's been put on, economic sanctions that have been put on the Russian oligarchs and all the Russian banks and all that. So that shouldn't happen to China. So all these pieces of news all came out coincidentally, or you might even say that actually maybe China planned it, right? On the 16th of March, all these things all came out more or less at the same time, right? So this is something I just want to highlight, and that's also one of the more important things on why the market also reacted like what it did on the 16th of March. And moving on, right, I also want to highlight some of the things that actually was talked about on the 16th of March in terms of the Chinese property sector. So I'm sure all of you who are keen Chinese watchers, you will know that the Chinese property sector is undergoing a lot of stress at this point in time. And however, our base case is that the Chinese government is well aware of the issue. They have in fact implemented quite a fair bit of easing measure on the Chinese property sector. Right. So more importantly, like for example, there's not going to be any property tax that's going to be implemented until the market stabilizes. So that was a very important signal that the government was giving the market. And also more importantly, right, we also noticed that there were more localized loosening measures, right? That was done mainly in the third and fourth tier city, but are also spreading to the tier 1, tier 2 cities as well, right? So that allowed Chinese people to be able to buy property easier. So we are starting to see some form of loosening measures already, and this is very, very different from the very, very strict tightening measures that we saw in 2021, right? So this is a very, very marked difference, and in terms of the posture of the government. And also, not only that, we are also starting to see mortgage rates, right, which are essentially controlled by the Chinese government, are starting to fall back down. Same thing for down payment ratios as well. So we are seeing quite a fair bit of policy measures that have been eased, right, on the Chinese property sector. However, we are still cautious about the Chinese property sector. In particular, over the course of the last few weeks, you will notice that some of the listed Chinese property companies, especially the weaker ones, right? In essence, it has been only the weaker ones that have been suspended because they were not able to submit their annual reports in time, right? So this is something I just want to highlight to everybody. So it's very, very important that investors like ourselves have to be very, very careful on specific stock picks, despite the fact that we do think that there is some form of easing that's happening on the Chinese property sector. So on at least on government regulatory front, right, or the policy front, we are seeing a bit of an inflection point. Okay, and moving on, right, I also want to talk a bit about the easing measures that is happening in China at this point in time. So on this chart here, what I've indicated are the benchmark rates of all the different ASEAN, of all the different Asian countries. So I'm sure all of you are well aware that the US is it's in the middle of hiking rates. So we have seen rate hikes happening, have started to happen in March. We are starting, it's expected that in May, there'll be another round of rate hikes, and the market is looking at anywhere between 6 to 7 rate hikes for the entire this year, and a couple more rate hikes next year, right? So I think we are seeing liquidity being tightened in US, and that is obviously going to spread to other parts of the world in view of all the inflation pressures that we have seen. The thing I want to highlight to everybody is that for those of you who are worried about tightening of liquidity in US and other parts of the world, then I do think that you should consider China, because China is in fact at the opposite end of the spectrum. So instead of tightening, right, China is in fact loosening. So we have already seen one benchmark rate cut that happened, and I do think that that this loosening stance will continue to be the policy of the Chinese government. And also, more importantly, it's not just benchmark rate cut. We have seen RRR cuts in 2021. In fact, there were 2 of them, right? So the reserve requirement ratio was cut twice in 2021. One was in June, the other one was, and another surprise one was in December of last year, right? So we are seeing a lot of things that is happening on the policy front. And also more importantly, right, like what I mentioned earlier, it's not just on the monetary policy. There is loosening stance in terms of fiscal policy as well. There's going to be more stimulus. In terms of property, it's going to be less tight compared to what we saw in 2021. And last but not least, like what I mentioned earlier, in terms of industry regulations, our view is that we are probably at the tail end of it. And also more importantly, right, I think all these industry regulations is actually quite well flagged, right? So I think all of you here are well aware of the regulations that's been implemented on the Chinese internet companies. So we do think that we are probably seeing the end of that, and there have been no new surprises that we have seen over the course of the last few months, right? So I do think that the easing measures that we have in China is happening on multiple fronts, right? So once again, the point I want to highlight for this section is that for investors who are worried about tightening, right, then you might want to look towards China, because China is doing the exact opposite. They are loosening. Liquidity continues to be ample, and policies are being loosened on multiple fronts. Okay, and also last but not least, I just want to touch very briefly on our portfolio positioning. As you can see here, we do have quite a fair bit of exposure to the Chinese internet sector, bearing in mind that our view is that we're probably coming to the end of the regulatory tightening. So once again, this is not a consensus view. You can see the performance of the share prices of Chinese internet stocks. I think a lot of people are still quite skeptical, but our view is that we are probably seeing the worst of it, right? So we are starting to build our position back into this stock because they are indeed very, very cheap. And also more importantly, we are also very, very positive on some of the key franchise names, good quality names that we think will tend to do very, very well as Chinese economy starts to loosen, and that will include stocks that are in the financial sector. We do think that they will tend to do quite well in this kind of scenarios. And also on this chart here, just wanted to indicate to everybody our change in position over the course of March 2022. I think it's important for us to highlight that we had quite a fair bit of cash going into the Russian-Ukraine war. So in fact, we raised our cash level in the early part of February. So bear in mind that the Russia invasion actually only happened in late February, but in the first week of February, we already raised cash levels quite high, because at that point in time, there were already talks that Russia is building up their military around Ukraine already. So that's why we took the opportunity in early March to actually raise quite a fair bit of cash, right? So, but with what has happened over the course of the last few months or so, last few weeks or so, we feel that, I think the Chinese government have made it very clear of their intentions to stimulate the economy, as well as to ease some of the policies that we feel have been overly penalizing a lot of these Chinese companies. So once that has been loosened, we do think that there are going to be a lot more breathing space for a lot of these Chinese companies. That would include the companies that operates in the Chinese consumer discretionary sector, or the internet sector, or the IT sector. We do think that they will tend to do quite well in that kind of scenario. And therefore, we've taken the opportunity. If you look at it, the share price of the Chinese stock market has did a fair bit of was derated somewhat in the middle of March prior to the 16th of March announcement. We have taken that opportunity to actually build up our position, and with the announcements that were made post 16th of March, that gave us added confidence. So we have taken the opportunity to actually deploy some of our cash to buy some of the key stocks that we think will tend to do quite well in this environment. Okay. And with that, I've actually come to the end of my prepared remarks. And with that, maybe I'll pass it over to Yvonne, and maybe we can take some questions and answers. Yvonne, over to you.
Okay, thank you very much, Ms. Tan. It is a very insightful presentation and sharing. And so we will move on to the question and answer session. There are a few questions over here. And the first question is, will the current lockdown in major cities as a result of China's zero COVID-19 policy affect the growth and supply chain in China? And will it affect the growth and GDP?
Okay, I think that's a very good question. And in fact, it's very topical, right? Considering what we have seen in some of the major cities. We know that Shenzhen, Shanghai has been in the lockdown over the course of the last few weeks. Okay, so I think it's logical that we have to ask ourselves, what is the economic impact that these lockdowns will have on China? Okay, so first and foremost, right, just want to highlight to everybody that last year, China actually grew 8.1%. 8.1%. Their guidance for the year was above 6%, right? So in the end, they grew about 8.1%. And last year, China also had that zero COVID policy, right? So the zero COVID policy that China had is not something new, right? So I'm sure all of you are well aware that ever since the Wuhan issues, right, Wuhan virus, or Wuhan was locked down, China's policy has been to totally eradicate COVID on shore, right? So the zero COVID policy is one of the key tenets of China's COVID strategy, right? So I think right now it has become a lot more difficult because with Omicron, and also more importantly, the rest of the world are starting to open up. So a lot of people are asking that question. But my counter to that would be, like I mentioned earlier, China's zero COVID policy has always been a policy since essentially day one, right? So it's not something that they have implemented and that is catching the market by surprise, right? So that's one. And also, the other thing I want to highlight to everybody is that China's guidance in terms of GDP growth for this year is around 5.5, right? So this is something that they have highlighted to everybody. So if you look at it, they are already indicating that growth this year is probably going to be slower than last year, right? So by having said that, I think it's still going to be pretty decent growth, right? So I do think that the zero COVID policy was taken into consideration when Chinese government actually came out with the GDP growth guidance for this year. And also I just want to highlight to everybody is that Chinese government, like I mentioned earlier, is embarking on a whole series of loosening measures, right? So this is something that they are well aware of, and they are trying to ease and trying to stimulate their economy, right? So, and granted, I think it's also quite valid that investors, and ourselves included, are watching the situation in terms of the lockdown in China quite closely, right? So the thing I just want to highlight to everybody is that China, instead of what we call the absolute zero COVID policy, they are embarking on a new form of zero COVID policy called dynamic zero COVID policy. So they are actually locking instead of one whole city getting locked down, they do it by xiaoqu, they do it by, in Shanghai, in the case of Shanghai, they will do it by cutting the city in half. So at some point in time, right, some of the cities some parts of cities are in fact operational. Right, so this xiaoqu and certain parts of cities getting locked down, it's definitely less stringent than what we saw in China previously, right? So we do think that they are also trying to adapt to this new world, right? And also, fortunately, in the case of China, a large swath of their populations are in fact vaccinated, right? So 90+% of their people are already vaccinated, and also it's also thankful that Omicron is also not as deadly. Like we know that Omicron is a lot more transmissible, but it's definitely less deadly. So we haven't seen massive impact, negative impact on the Chinese ICU and the Chinese hospital, but definitely it's quite chaotic, right? So as you can imagine, right? So, but I do think that if China can contain the Omicron outbreak in Shanghai and Shenzhen effectively over the course of the next few weeks, then things should more or less get back to normal, right? So, and like I mentioned earlier, China 5.5%, I do think that that is the zero COVID policy is taken into consideration. And I do think that they are also implementing quite a fair bit of loosening measure that should be able to buffer this temporarily slow down in the economy due to this lockdown. Okay, I hope I answered that question. Yvonne?
Okay, thank you, Mr. Tan. We have another question. Earlier, you shared us about the property sector in China. So in terms of the Chinese developer, do you see any further elevated defaults and volatility remain before an eventual recovery of prudent developers left standing?
Okay, I think the Chinese developer, right? Okay, the defaults that we have seen, right, is actually quite well flagged already and quite well understood by the Chinese investors, right? Why I say that is because a lot of these companies, they're already in trouble. If you look at the bond pricing for a lot of these Chinese developers, right, they are already trading at 20 cents to the dollar, right? So I think the markets have already priced this in for the market for this weak Chinese developer over the course of the last few months already, right? So even the recent news about some of these Chinese developer getting delisted, right? A lot of this have more or less is quite well known, right? So we really know that Sunak, for example, is going to be in trouble, right? So the property prices, their stock market prices and their bond prices have already reflected that. But the other thing I just want to highlight to everybody is that if you look at our big cap China portfolio, right, we actually never ever had Evergrande. Over the course of the last 4+ years that I've been managing this fund, we never ever had Evergrande, right? Despite the fact that Evergrande was the second largest property company in China, we never had that. So the reason is because we already knew that they had weak governance, they had issues with their working capital, they were very, very aggressive. So in fact, prior to this whole issue that happened in the third quarter of last year, we actually had, for the bulk of last year, we actually had zero exposure to the Chinese property sector, right? The point I want to highlight to everybody is that, okay, it's quite fortunate that we don't have that, and therefore the bulk of this decline in the Chinese property stock didn't really affect the big cap China fund much, right? So that's one. And also the point I want to highlight to everybody is that I think the reason why we didn't have it was because I think the writing was already on the wall, right? Whether people were paying attention to it, that's another story. But from our perspective, the bulk of last year, we did not have any Chinese property stock at all. Was because we were already aware that was what was happening. But maybe some of the retail investors, some of the guys or more aggressive ones were not too cognizant of the issue, because at the end of the day, right, if you think about last year, those Chinese property bonds were trading at double-digit yields, right? So for some of them, who are a bit greedy or a bit aggressive, they might find that it was quite attractive, right? And so therefore they went in, right? So as you can see this year, a lot of this bond, a lot of these equity property stocks actually de-rated substantially, right? So I do think that it's important to understand what the government is doing. The reason why all these things happened was because the government was too tight last year, but we are starting to see them loosen already. So our view is that some of the weaker ones will be forced out of the market, and actually that's good for the overall market in general. So for us, right, what we have done is we have concentrated our efforts on all the key quality names, because end of the day, right, some of these Chinese stocks, key quality Chinese property companies will be well positioned to take advantage of this current weakness. Because once these small guys go bankrupt or they go belly up, the big guys are able to consolidate them and they will benefit. And if you look at the share prices of these good quality companies, right, you can see some of them are in fact up, right, where some of the weaker ones are down 15-20% year to date, right? So there is already a differentiation that is happening right now. So once again, like what our client has mentioned, right, it's quite true. There will be an eventual recovery, and a lot of these prudent developers will stand to benefit, right, from this restructuring.
Thank you, Mr. Tan. And then we move on to the next question. Do you see any potential political risk due to the election of the Chinese Communist Party later this year, in terms of also economic policies and the investor confidence in China?
Okay, so we all know that there's not going to be an election now. So chances are Xi Jinping will carry on for his third term, right? So we do think that, Xi Jinping is indeed very, very powerful. I think, history will show that he's, apart from Mao Zedong, Deng Xiaoping, I think Xi Jinping will be spoken about, his name will be spoken about in the same breath of all these key leaders of China, right? So we don't think that there's going to be any substantial change. And I think it's at this juncture, I think the runway is clear for Xi Jinping to carry on, right? So in terms of political risk, I do not think that there's going to be a big issue on that front. Okay.
Okay, thank you, Ms. Tan. And the next question is, during the 5th session of the 13th National People Congress press conference on March 11, 2022, Premier Li Keqiang reaffirmed China's policy towards common prosperity. Will this continue to affect the large technology companies such as Alibaba?
Okay, so the common prosperity policy was something that was started talking about quite extensively from the second half of last year, right? So we do think that the recent noises from the senior leadership of China have marked a distinct change in their body language. From common prosperity, they have now talked about stability, they have talked about growth, and the fact that Liu He came out and did this whole slew of announcements, right, does indicate to us that definitely policy has changed, right? So in terms of government policy focus has changed. So last year was about control, was about redistribution. I think it's and also I just want to highlight to everybody that whatever is happening in China is not something that is only particular to China, right? We can also see that in other parts of the world, governments, in Europe, in US, are also enacting policies and regulations that aim to control the likes of Google, Amazon, and all of that, right? So because during the whole COVID crisis, I think all these internet companies, be it China, outside China or inside China, have become a lot more powerful, right? And also a lot of these founder of these internet companies have become billionaires, right? So and I think people are well aware of the stark fortunes of these internet billionaires compared to the man in the street, right? So I mean, everybody's talking about this K-shaped recovery, whereby the billionaires are obviously doing very well, so that's why the K, and whereas the common folks have suffered over the course of the whole COVID crisis, and that's the downward curve for the K. So the discrepancy between the rich and the poor have become more and more apparent, and that's not just happening in China, it's happening over the world. But whereas for the Western world, for example, right, it's a lot more democratic. They can lobby. You have seen the UK royal family, in fact, UN have criticized the internet billionaires for their space race, right? Because all of them have been, clamoring to be the first one to go up in space, right? And they're spending billions and billions of dollars on that. The Elon Musk of the world, have hawked the headlines. Bezos of the world have hawked the headlines, right? So the royal, like I mentioned earlier, the UK royal family, UN have came out and actually criticized them and to tell them they should spend their money on solving problems on Earth, right, instead of joyriding in space, right? So that's happening outside China, but within China, I think the same sentiments is being felt, but it's also the fact that it's important to highlight that in China, they do it very differently. If the China's senior leadership wants to do something, they'll just implement it, right? They don't have to go through a parliament. They don't have to go through the lawmakers, and they can discuss, and then the lobbyists will come in, right? Whatever they want, they'll just implement, right? So China is in fact short-circuiting a lot of this process, but the rest of the Western world, right, will go through that, but that will take time. And my prediction is over the course of the next few years, we will see a lot more regulations on the Chinese internet companies, and also the discrepancy in fortunes of the billionaires and the common folks will start to take a bigger stage, right? So I think case in point in Malaysia, for example, the capital gains tax is also part of this, right? So you can call it common prosperity. They call it common prosperity in China, but no matter what, it's some form of redistribution, right? And in US, they're talking about the billionaire tax, right? So all these things are happening, but the speed, right, and the pace of how all these changes happen differs from country to country, right? Some countries who are more powerful, who are a bit more socialist, can able to push it through, right? But some countries who are more capitalist, more democratic, then they will just have to discuss, sit around, and just have to wait for society to change their minds, right? And for the lawmakers to lobby for change, right? So this is something I just want to point out. Okay.
Okay, thank you, Mr. Tan. And then earlier you talked about the financial stocks. Could you share us more about your optimistic view on financial stock, and would economic slowdown affect their earning?
Okay. So for some of the financial stock, the reason why we have quite a fair bit of exposure there is because our view was that prior to Liu He's announcement on 16th of March, right, quite a fair bit of pessimism. There was quite a bit of pessimism on the Chinese internet stocks. So quite a fair bit of sectors were actually under quite a fair bit of stress, right? So we thought that the financial stocks would be in a good position to weather this because China was actually doing quite well. Some of the Chinese financial stocks were actually derated for, in our view, to levels that we think were very attractive, right? Because end of the day, there were no big issue in China at a point in time. There were no major NPLs. China weathered COVID very, very well, right? So we do think that, with the loosening that is happening, with the easing, we do think that the Chinese financial stock will be a good place to make some money. So if you look at some of the Chinese financial stock, indeed, they did quite well, right? So that is been a good place for us to park our money. But our view is that right now there's been a distinct change in the policies of the Chinese government. So we do think that that will necessitate some form of portfolio changes for us as well. As what we mentioned earlier, we have quite a fair bit of cash, we have quite a fair bit of financial stocks, and those guys have done very well for us. So we might take the opportunity to rotate to other sectors and segments that we think will do much better with the changes that Liu He has signaled. Okay, I hope I answered that question.
Thank you, Mr. Tan. And then now we'll move on to the about the fund. What would be the positive and negative impact to RHB Big Cap China Fund?
Okay, positive to negative impact. Okay, so okay, let's talk about the positive impact first. So once again, right, we think that in fact this Russia-Ukraine war actually shows how defensive the Chinese economy is, because end of the day, what has happened in Russia-Ukraine affects the European stock market, the European economies directly, right? We have seen energy costs spiking up. We have seen inflation shooting up. So it's happening right at their doorstep. So that has a major impact on their immediate economy. But for places like, for example, in Asia, in China, for example, right, technically, the war doesn't actually affect them directly, right? It affects them through the financial market, but it doesn't really affect them much, right, from an economic perspective, because if you think about it, the rest of the world continue to hum quite nicely, and that is assuming that this Russia-Ukraine war doesn't degenerate into something like a World War III type, which is not our base case, right? So it has been more or less been well controlled, and it has been more or less anchored in just Europe, right? So China has sort of like been sheltered from that. So I think that's a major a positive impact from what has happened over the course of the last few days. And the other thing is also, like what I mentioned earlier, right? The tightening of the economic conditions that is happening in other parts of the world, it's not happening in China. There is quite a fair bit of easing that's happening in China, and that will obviously give China quite a fair bit of buffer, right? Because other places are liquidity is tightening. China, in fact, liquidity is loosening up. So I do think that there is quite a fair bit of distinction there, and also I think I want to highlight to everybody is that if we have also gone out and checked with all our investing companies what is the impact of the Russia-Ukraine war, and in a lot of their cases, right, I think life goes on for them, right? It doesn't really affect them much because a lot of Chinese economy is dependent on what is happening within China. So not they are not significantly impacted by what is happening in Europe at this point in time. So they are quite well protected. And also for those of you who are worried about inflation, right? The inflation is indeed spiking in some parts of the world. We have seen it in Korea. We've seen, in fact, in Singapore as well. We've seen it in the US, especially for Asia, especially if you are a lot more dependent on oil or you are very exposed to the external environment, then inflation might flow through, right? So in certain parts of Asia, like what I mentioned earlier, in the US, in Europe, inflation is a big issue. But within China, right, it's in fact quite muted, right? Inflation doesn't filter through to China. So that is one of the key differences, at least we can see from our end, right? So that is some of the positive part. But this is not to say that, let's talk about the negative part. This is not to say that China is entirely sheltered, because end of the day, right, the world is quite interconnected, right? The fund flows to the financial markets, to risk premium, to fear, to greed. China's stock markets, it's also impacted from that perspective, right? So like what I mentioned earlier, initially people were worried about Russia, Ukraine, that might translate into China, Taiwan. So people started to sell down. People were worried about that. People were worried about China getting involved in the war, because that was what unnamed US officials seem to indicate, right? So all this does affect the Chinese equity markets, right? So this is something that I want to highlight, and no matter what, right, that will affect the volatility, right? But I think it's good that the Chinese government came out and clarified on a lot of these issues. So these are some of the negative impact, in fact, that has happened over the course of the last few months or so, right? So last but not least, right, I think we need to monitor the COVID situation in China carefully, right? So right now, Shenzhen, Shanghai is under lockdown. We have to monitor to see how they are managing this lockdown, whether they can get out of that lockdown. I think their target is by the middle of April. We should see some of these lockdowns getting lifted, right? So these are some of the key things that we are looking at, and some of the positive and negative impact for the Chinese equity stock markets. Yvonne?
Okay, thank you, Mr. Tan. In the interest of time, we will take one more final questions. So for the investor that currently holding China equities, what is your view for them in this current market outlook? And also, how about for the new investor? How should they position in their portfolio?
Okay. So I think some of investors might be concerned about the Big Cap China Fund. And Big Cap China Fund in 2021, we were down roughly about 15-20%. But bearing in mind that in 2020, we were up about 44%, right? So for those, I guess it very much depends on investors, when did they come into the fund. But overall, I think over the course of the last 4 or 5 years that we're managing the fund, the compounded returns for the fund has been quite steady. Compounded returns of the fund have been quite steady, anywhere between 8 to 10%. But there is obviously volatility in the fund, right? So I do think that I think when you invest into China, I think the view must be that I think the China will continue to grow. I think the growth of China, the fact that China is now in a position to compete directly against US, that has to be the base case, right? So, and because of that, the US is not going to go over and play it and try to, just allow China to grow and be a substantial competitor to them on all fronts, right? Be it on the military front, political front, on technology front, financial front, on the currency front. So we are in our lifetime. So right now we are seeing the fact that there are two superpowers, one that is up and coming, one is trying to defend their position. And in this situation, it's going to be competitive, right? We are hoping that it won't resort to what, the world that the whole economy, that the world that Trump envisioned it to be, whereby China and US are in direct competition and they are being very aggressive with each other. In the case of Biden, I think they're still competitive, right? So, but they have been, trying to cooperate wherever they can. And I do think that because of what we are seeing now, right, there will be volatility. But I also want to highlight to everybody is the reason why there's volatility is because China is up and coming. I think mathematically, it's almost for certain within the next 10 years or so, China will be the biggest economy in the world, right? So that has to be a long-term structural story for China. And because China is trying to be the biggest economy in the world, US will try their best to put a stop to it. So from my perspective, right, that I do think that, the base case has to be that China will continue to grow and will continue to prosper. China will never go over and also play dead, right, and let US put on the sanctions and put on all these restrictions and stop China from growing, right? So that is not practical as well, right? And we do think that China's growth rate, no matter what, will still going to be higher than the average growth rate than what we see all over the world. Right. And the fact is, because of what has happened, right, certain segments in the Chinese economy, like for example, the internet sector, the tech sector, are indeed very interesting. They are world leading in their own right. And we do think that we need to have substantial exposure there. And also more importantly, a lot of these stocks are trading at incredibly cheap valuations, right? So we do think that, I think, volatility is part and parcel of investing, and we should try to take advantage of this volatility, right? If investors, like ourselves, are of the view that China will continue to grow and are confident of the growth prospects of China, then I do think that the volatility that has presented itself over the course of the last few quarters, right, actually gives us a good chance for us to go in and buy more at this kind of valuations, right? So we do think that I think investing is for the medium and long term is hard to avoid all this short-term volatility, especially in light of what is happening on the geopolitical front, right? So, but we do think that with this volatility, we can take advantage of the cheap valuations that is presenting to us, and therefore, I think over the medium to long term, we can take advantage of that and try to make alpha for our clients. Okay, Yvonne, over to you.
Okay. Thank you very much, Ms. Tan. This is a very insightful sharing. Ladies and gentlemen, this will be the end of the question and answer session. If you have any further questions, please feel free to send us an email at investhelp.myfundsupermart.com. The link is in the chat box. A replay of today's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. Once again, thank you very much, Ms. Tan, for joining us today. And thank you everyone for attending today's session. By this, we will end the webinar. Take care and stay safe. Have a pleasant day ahead.
Thank you very much. Thank you, everyone.
Thank you.